Good evening, you're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi Julieta.
Garth, we'll start off by talking about the S&P 500, which after an absolute humdinger February has gone nowhere, it seems.
Yeah, that's right. It's gone rather sideways throughout March. You can see that into the beginning of March, although that might have even been the last trading day of February, there was a big gap up, which has subsequently resulted in some consolidation. We looked at this chart last week. We look at it every week, but what we highlighted last week was the fact that the index had pulled back to this uptrend support, and that uptrend support started in November last year when Donald Trump won the US election. It pulled back, it found support at 23.55, and then it moved up off that support level. And it stays above that upward trend. So while that's the case, I think we do still have to give the benefit of the doubt to the upside for this market. But you know, and I think we will continue to do that until such time as that trend gets broken. We do have an option structure in place, which we discussed a couple of weeks ago, and without getting into too much detail, you can just see the payoff profile of that option structure on the right-hand side there. So above 23.50, we pay away an option premium of $140, but if the S&P 500 goes below 23.50, then we start to make money. And you can see the sweet spot for us is down here between 22.80 down to 21.80. There we would make $1,260. And the expiry for this structure is on the 21st of April. So we've got about a month left. Whether it works or not is very difficult to say from here. But I am fairly comforted by having this structure in the background. And if it doesn't work, if we end the quarter or in this particular contract period out the money, very good chance I'll put another one of these things on with another 2 months out, maybe roll it forward a little bit, because I do think at some stage this US market is going to correct, and when it happens, I'd like to be able to participate in that. And if we're losing $140, as the case is here on a premium, it's not a lot of money to pay away, to always have that downside protection.
Yeah. I mean, having gone nowhere, it would be nice to see it pull back, because indeed it would pay off for us if the next month or so is the period in which to take advantage of a pullback. Yeah. Garth, what about a recent trade? Okay, before we get to that though, the top 40 of the JSE, we seem to be going places finally. Yes,
we have started to go places after last week's FOMC interest rate increase, which was well received by markets. We saw the top 40 index jumping quite nicely. And then there was the futures closeout last week, Thursday, which also saw a little bit of derivatives-related activity pushing the market a bit higher, but the derivatives was rather muted this year. But anyway, from a technical standpoint, you can see that this market has been in this downward sloping channel, which we've talked about at length in previous shows. We have now started to see the market breaking up above the top of that channel structure. And that points to the potential for a little bit more upside still in the near term. So I think as things stand right now, we've probably got to give the benefit of the doubt to the upside for our top 40 index as things stand at the moment.
And of course, one of the key shares there is Naspers, because that's possibly one of the components that we're seeing behind the rally in the top 40 index. And that was last week's trade. And I imagine that you're very happy to be in it at the moment.
Yes, I'm very happy to be in it. What we discussed last week was this chart, and this was really the basis for wanting to take a long position in Naspers. And it really shows the relationship between Naspers and Tencent. Now, obviously, Tencent is a very significant component in Naspers' asset makeup. Naspers owns 34% of Tencent, and in Naspers' life, that equates to about 85% of their business. But that stake, in terms of its actual value, is worth more than the entire market capitalization of Naspers, which is a really odd thing. But anyway, that's been like that for a while. And what I particularly picked up on in last week's show was the fact that on this graph, which is about 4 or 5 months worth of trading here, you can see there's been a fairly tight correlation between the charts of the two shares. Naspers is the purple line, and Tencent is the candlestick chart over there. And you can see how they were tightly correlated right up until about the middle of February. And then this correlation began to break down to some extent. And you can see that Naspers is actually, on a relative basis, it's been underperforming Tencent. So my feeling was that you should start to see some sort of a catch-up in the price of Naspers. Part of the reason I believe why there's been this disconnect is because a lot of funds are changing their benchmark away from a top 40 or an all-share index benchmark, moving more towards an equal-weighted SWIX index, which meant that it left a lot of funds very overweight Naspers. And in order for those funds to get back to the correct weighting, they would have to downweight their positions in Naspers. And I believe that's why you've seen this underperformance. So it's a short-term thing. And my sense was that it was always going to normalize again. So I wanted to buy Naspers based on the fact that Tencent is strong, and I think that there's a likelihood that Naspers has to catch up to Tencent. So that's the relative chart of the two stocks over there. If you have a look here now, this is the absolute share price graph of Naspers itself listed on our market. And what I'd identified last week was the fact that the stock is trading in the sideways channel. It's basically been like this throughout the whole of this year, really, other than the first week of January. But since the second week of January, Naspers has been stuck in this range between 2,100 Rand and up to about 2,200 Rand, or just a little bit above that sort of area. And it looked to me like we were going to see a break to the upside. That has now begun to happen. It doesn't reflect on this graph because it's this graph only takes up to yesterday's closing price. But actually where the share is trading today is about 2,280 Rand. So it's looking very good for us. We went long last week at 2,165, and we bought 30 CFDs with a stop loss of 2,100 Rand. That stop loss would have meant that we needed to see the price break below the bottom of the trading range, which I felt was a low probability likelihood. The target I had here was 2,300 Rand, but the more I look at this chart, actually I think that target is probably too conservative. I think you can justify a bigger target than that. I think you can justify 2,350, maybe even 2,400, and possibly even a little bit higher than that. So what I'll probably look to do here is actually try and run the profit on this trade, rather than just closing it at our target price and then leaving a whole bunch of possible money on the table. I think I'd like to try and run this profit a little bit longer and keep the trade open for a while to see if we can extract the maximum profit out of it that we can.
I mean, that's sort of always, given the trading action of the last year, and actually you mentioned it last week, you've been nervous to do that because profits tend to reverse quite quickly in the market that we've experienced. So are there any trading strategies that you would need to adapt, like a trailing stop loss was one of the things that you suggested? Yeah,
so trailing stop loss might be something to look at here in order to try and run a profit. So trailing stop loss effectively takes it trails behind the price action. So for example, what might work in a situation like this is to perhaps look at a previous day's low or a previous 2-day low and use that as a trailing stop loss. So as long as the price is rising and trending higher and it's not breaching the previous 2-day low, you stay in the trade. And that allows you to then continually ratchet up a stop loss as the price goes higher. But if it starts to turn down, then you get taken out and basically protect your profits. And I think that sort of strategy may well work here, because we do find that when Naspers starts to run, it can quite often actually run and trend quite nicely. And if that is to be the case, then I'd like to try and extract the maximum profit here that we can. I mean, that sideways consolidation that's almost 3 months long there actually does set a very big base for a nice move to the upside. So let's try and make the best of it as we possibly can.
Yeah, we were joking about the Traders Corner nag at the start of the show. It's been slow out of the blocks this year, so let's give it a bit of a thumping.
Let's give it room to run.
Garth, then this week's trade is a long position in GlaxoSmithKline, and that is via your offshore portfolio.
That's right, yeah. We've got obviously two portfolios that we're running this year. We've got an offshore component, which is in London, and we've got a local component here in South Africa. And we toggle between the two. So this week we're taking an offshore focus in terms of the trade that we're doing. We're looking at the share price here of GlaxoSmithKline. The company needs no introduction. It's a massive global pharmaceutical giant. Listed in London. It's listed on other markets around the world as well. But we're specifically trading it in London here. What gets me interested here is the fact that this share price performance is fairly strong. It's been moving higher. You can see your 200-day moving average and your 50-day moving averages are both pointing to the upside. We've got what appears to be an ascending triangle formation busy building over here. And my sense is that if it starts to push out above the upper boundary of this ascending triangle, then it's going to probably go back to the high that we saw in October last year, which is up at £17.50. So that to me looks like a fairly high probability outcome here. If I zoom in a bit and I now have a look at the 1-hour chart of Glaxo, so this actually shows that ascending triangle pattern a little bit more clearly, because every candlestick pattern here represents 1 hour's worth of trade versus the previous graph, which was a daily graph. Here you can see quite clearly we've got a couple of waves, wave 1, 2, 3, 4, and now we're possibly about to see the 5th wave breaking to the upside. The overhead resistance here that we're looking at is about £16.93. And if the share price starts to breach above that level, then that would be a bullish break, which would then project up to that target of £17.50 that I mentioned. So I've gone long here at £16.86 here. I've actually preempted the break, which you might argue is a bit of a dangerous strategy, or perhaps a little bit more risky. But what I do find is that doing this then improves my risk to reward ratio. If I'm right, our risk to reward ratio will be much better, whereas if I have to wait for a break and then start chasing the price once it's broken, often I don't get the best entry. So I'm preempting a breakout here, buying it at £16.86 with a stop loss below £16.65. That would mean we need to take out that low of a couple of days back that you can see I'm pointing out over there now. If that low starts to be breached to the downside, well then I'm going to have to concede the trade's not working. But to me, for now, the higher probability outcome looks like a break to the upside is coming here.
And any fundamental factors? I mean, I suppose you've got to take into consideration what happens to the pounds, maybe nervousness around Brexit. I know that they're set to trigger Article 50 on the 29th of March. And also, I guess, nervousness that has been apparent in the market about pharmaceutical stocks as a result of Trump's would-be policies in the United States. Yeah.
Look, all of those factors are known already. I'm a big believer that when I'm trading, I'm mostly guided by what I see in the chart because we're short-term traders. And the chart takes into account all of that fundamental information as it is known at this point in time, and still the price hasn't come back. It still looks as if it's poised to break to the upside. Okay. So based on that, I'm happy to go long here. But of course, we always trade with a stop loss in the event that I am wrong.
Yeah. Okay. Well, take us to the trade in greater detail.
All right. So we've gone long at £16.86. My stop loss is £16.65. My risk per share, therefore, is 21 pence. The risk, I'm taking a £100 risk. It doesn't sound like a lot. It's 1% of our capital. Remember, we've got £10,000 that we're trading here, so 1% of £10,000 is £100. Divide that £100 by the risk per share of 21 pence. It gives me 476 shares. So I've decided to round that up to 500 CFDs just to get a round figure. My target is £17.50, and that therefore means that our risk to reward ratio on this trade is 1:3, which is pretty fine in my eyes.
Yeah. Okay. So what does the portfolio look like? Because you've got, well, in both Rand and Pound terms.
Yeah, so first of all, the Rand portfolio is here. You can see there's the recent trade that we took on Naspers, which is still open. We've got a mark-to-market profit running of almost 3,000 Rand there, so that's looking good for us. The portfolio there is up 1.8% for the year to date. And then our Pound portfolio, the offshore portfolio, has these two positions. Obviously, we've got our S&P 500 option structure. That's running in the background, and then this trade for this week where we've gone long of Glaxo at £16.86. There we are just underneath our £10,000 starting capital, but let's hope that this Glaxo trade starts to work out for us and puts us on the right side of the ledger in terms of our offshore portfolio.
Yeah, I mean, you know, going back to my earlier comment about being slow out the blocks, last year was actually a very slow start to the year. I think it was only in April when trades really started kind of pulling through for the portfolio.
Absolutely. It's very similar to this year, actually. We struggled to get out the blocks in the first quarter of the year, and only after April, May, suddenly we started to string a couple of winning trades together, and then it actually turned out to be a fairly good year in the end. So we hope that the same will happen this year.
Yeah. All right, Garth. And just to end off with a reminder of a weekly alert that subscribers can receive.
Yes, if you go to traderscorner.co.za, you can go and click on the free weekly email link in the middle of the page there. It's a quick registration process. Sign up and you'll receive a free email from us every Tuesday detailing what is coming up on the show for that week.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.